Welcome. In this episode, we are continuing to look at early imperialism, and we will have an emphasis on the economic motives of imperialism. And one of the main things we will accomplish today is to look at some basic, sort of nuts and bolts definitions of some economic terms. Well, you can't get any more basic in economics than defining the term money. What is money? Whether you want to think of it as credit, numbers in a computer, numbers on a check, cash, coins. Say you work for 40 hours, or say you give someone your car, and in exchange, they give you paper with numbers on it. Why? Why would you give someone something so useful as a car or work for them all week and they give you paper or numbers on a computer? Because money is a holder of value. Money is money because we all believe that it's money. We believe that we accept money because we believe that when we go and we want to go buy a car or a hamburger or hire someone to work and do some job for us, that we'll give them paper or coins or numbers in a computer and they'll give us stuff or work for us. Money is money because we all believe that it's money and we all treat it as this holder of value. Money works because we all believe it works. And so it works. So, following that, what are some other terms for types of money? One term you might be familiar with is income. This is money coming in, and this could be for an individual or for a business. When you talk about business income, you might hear about gross or net income. Gross income, net income. Net income isn't exactly the same as profit, but it's related. And for a simple introduction, they're very similar. So I struggled to keep these apart. I'm not an accountant, I'm a teacher, and I always tended to forget gross, net, which is which. And so I thought of this sort of goofy memory trick to help you out. If you're ever like, all right, gross income, net income, which is which. So gross income is total income before you pay out your expenses. Net income is what's left over in the end. How you remember that is when I think of net, I think of like a fishing net. Okay. And so if we're going fishing, I picture like, say, you dip down a bucket and you get it full of lake water and you got some fish in there and some sediment and some kelp and just all kinds of gross, nasty stuff. That's your gross. Then you take your fishing net, you scoop it through, and you pull out just the fish, and that's your net. And so that kind of helps me to remember, like, okay, with everything in there, all the gross things like expenses and taxes and overhead, that's the gross income. It's everything, it's gross. And then what you dip out with your net is your net income. It's like your profit, like the good part that's left over after you pay all your bills. And so that basically explains it. We can look at this diagram right down here. Your gross income is the whole bar, that's everything. Net income is just that part of your income that's left over after you pay all your expenditures. So, yes, a rough synonym can be your profit, what's left over. Examples of what a business, for example, will have to have in expenditures is their labor costs. Got to pay your workers. And here's another just couple simple definitions you may or may not be familiar with is wages and salary. Wages traditionally refers to workers who are paid hourly. An hourly worker is paid wages, and someone who's paid monthly or annually or is on some type of a contract, that's typically called a salary. So with a wage earner, you typically get paid for each hour of work, and a salaried worker gets paid to complete a certain job, and it doesn't always matter how many hours they actually work. Other expenditures, often the biggest one is paying your workers, your labor, but others include taxes, rents or a mortgage, your utilities or insurance, the materials, the raw material cost, your equipment cost, including repairs or breakage, including just the fact that your equipment gets older, and that's called depreciation. So you start factoring in your eventual replacement cost of your machines. And so those are a couple of examples of expenditures. It's not exactly the same thing as overhead, but that's another term people use that is a particular term for some of the costs that go into running a business. And finally, another term for a type of money is called capital. Capital and money are not exactly the same thing. Capital is a particular type of money. Capital is money available for investment. And the best way to think of this, if you're not familiar, would be to picture the TV show Shark Tank, where you have these really rich sharks and they're giving money to these like nobodies, these people with these startup companies that have sold a few dozen things on the internet. Why? Because the sharks, the investors, they have capital, they have money. They're looking to give it to somebody else in the hopes of making even more money later. And so that's a particular type of money called capital. A few other definitions. I'm just going to hold off on supply, demand, price equilibrium. Um, it's a little easier to explain if we're in class. If you do an economics class, you could do easily a whole day, a whole unit. You can do a whole class just explaining and processing through supply and demand. The short version is supply is the availability of a product, and and demand is people's demand that want a product or service. And in capitalism, price often hits its price equilibrium point, is that spot where supply meets demand. So, um, again, it would really be helpful to have some charts and graphs, and I don't have that ready for you right now, so we'll put that off for another day. Why, then, with some of our economic terms that we'll be ready to use, why was imperialism so profitable? Because as Vasco da Gama had proof of concept, you could get 5, 10, 15, 20 times the profit if a European, a Portuguese, a Spaniard himself and his crew went to India, went to China, went to the Indies, and brought back these spices, this porcelain, this silk for themselves. 80, 90, 95% of the sale cost would go right into your pocket. It would almost all be net income. It would be kind of inverted because you were cutting out so much of this middleman, so much of the danger, so much of the middlemen, so much of the bureaucratic cost and the taxes, and you could put it all in your pocket. And so it was tremendously profitable. There was huge demand, there was very short supply, and the cost was very high. And for all those reasons for economics that we kind of talked about, and we could definitely go into more depth on, it was a huge profit could be turned. Why else did imperialism begin to make Europe wealthy? It's not just the profit margins of some of these wealthy shippers, but they invented the forerunner of modern insurance. So many ships didn't make it back, and it was very dangerous to do this sort of thing. And so you begin to have the rudiments of insurance, which is a really, sorry if your parents are in insurance, but it's a really boring topic. And so, but it's really necessary. It really makes the gears of the modern economy go around, that you can mitigate risk by purchasing insurance. And Europeans kind of invented this really boring thing that really makes capitalism go. Insurance is very powerful, and this relative forerunner of modern insurance is a big deal, and it helps to take risks, and risks are what help to generate profits in capitalism. The same with joint stock companies, which is similar to insurance, but the idea of limited liability corporations or pooling your resources in order so that you can take riskier ventures because you're making such massive profits. If only a few of those ships make it back, you're still good. But if you pour all your money into one ship and that one ship doesn't make it back, you're out. And so this basically forerunner of a modern corporation, these companies where many people would pool their resources, maybe they're taking out um, insurance policies, and they're able to take risks and make a profit. Again, to use the modern analogy that maybe a lot of us who just watch capitalism on TV are familiar with, it's a lot like Shark Tank, where you're risking your money. You might not get it back, but if you do, you might turn $100,000 into $1 million, like the sharks do sometimes. They also make money on the carrying trade, like building the ships, the sailors, the captains. Those are reasonable jobs that give people training, and there's more of them. They're building and repairing ships and working on the sailboats and things. And these are all a major industry that is created of carrying stuff all around the world, that these jobs are all going to these Europeans, and they're cutting out some of these jobs for these middlemen. And it's a boon to their own economy. They also have a demand. Another aspect of the economic sort of motives is the establishing of colonies. Okay, They have this desire that they have population pressure, that there's extra people. There's peasants. There are poor. There are people that don't have access to land or good jobs. And there are people that when there is available land, and available because a lot of times the Indians, the Native Americans, the indigenous people of the Americas are forced off the land, killed by disease, fleeing from whatever. But in very practical purposes, there was land that could be had. And what, for better or for worse, Europeans could push, people could settle there, and in a way that was unavailable more in their own region, which was similar to other parts of the world as well. They wanted to gain access to rare resources, right? When you trade, you want to trade for things you don't have. And the further away from where your geographic location is, the more likely that the climate, the minerals, the crops grown are different. And so they want access to rare materials, and they wanted it to gain a new market as well. Another term is this commercial revolution. A revolution, we might picture something revolving, right? Like it rotates or turns. Maybe not a full 360, but a lot of times when we use the word revolution, we mean like a complete turn, like a 180. It turns all the way around, a major change. A revolution in social studies, we're often talking about a major change, and it's a major change in not TV commercials or YouTube ads. Commercial meaning commerce, commerce meaning trade and the economy. So it's an economic trade commerce revolution. This refers to basically the invention of modern capitalism, the transition from a more traditional feudal economy to our modern capitalist economy is called the commercial revolution. It is brought about by this global trade networks that begin to be formed by Europeans, sort of initiated, not necessarily initiated, but transitioned by them, that begins making Europe very, stand out as being slightly richer and more powerful than other parts of the world, principally through this develop of capitalism, which is a great builder of wealth and mover of goods. Next, on the topic of inflation and deflation. Before we explain what that is, I want to talk quickly about, again, the three ways a government can raise money. Government can build revenue three ways. They can tax it. They demand the people pay a tax. They pay it. They can borrow it. In modern parlance, we call this bonds or T-bills. This is a main way. Our government, of course, taxes us. Our government also massively borrows money. It sells its debt. People give the government money, and in exchange, the government will pay them back with interest. You can do that. And then finally, people often say, why doesn't the government just print more, right? It's just, it's got George Washington's picture on it. Just print more of them. The issue is that causes inflation. It devalues each dollar. And a lot of times people just think, well, why don't we just do it fast enough or just a little bit? And that's true. If you just printed $1 extra or 50 extra dollars, wouldn't have any difference. But when you do it on a massive scale, you cause massive devaluation. And so there's more dollars out there, and so people bid up the prices of things. So prices go up. The supply of money goes up. Purchasing power, however, and the value of each unit of currency goes down. So if you're ever, thinking this through, it's like inflation, increase prices, increase wages, increase in the supply of money, decrease in the purchasing power and the value of each unit. And that comes out of inflation. Deflation is just the opposite. With deflation, prices and the supply of money will go down, and that means that the value of each dollar or unit of currency will go up. We will talk about that more in other units, but I just wanted to introduce inflation, deflation, and finally, the concept of mercantilism. Again, we see the term merchant in there. Mercantilism is a government policy where it intentionally tries to have a favorable balance of trade, meaning that the government wants there to be more exports than imports. People often get that wrong, but a car company doesn't want to import more cars. They want to sell cars, bring in money. And that's what a government wants its country to do, to be exporting stuff and bringing in fewer imports, and therefore you have a favorable balance of trade. This is not laissez-faire, where the government doesn't do anything. And the main tool they use in mercantilism is tariffs, or you tax imported goods in order to make imported goods more expensive so as to discourage them. That way, you don't import too many goods. Thanks for watching.